Hello everyone, welcome back to Upside Down Data. Today I want to talk about validating our trend confidence indicator through backtesting. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter where we put out regular updates about our risk indicators and more. So if you've been following the channel, you may have seen my video I put out earlier where I was first introduced to the trend confidence indicator. It's a indicator that we have here on the channel that I created recently. And one of the things that I talked about with that is that this indicator is really supposed to be capturing trends, right? It's supposed to be capturing how confident we can be in the current trend. So what I'm showing you here in this graph is just the price of Bitcoin over time color-coded to the trend confidence indicator's output. And so the trend confidence indicator doesn't have a set range, but for Bitcoin it ranges from around 4 to -4, but I've just left this full range, -5 to 5. And then 0 is that kind of critical level. So if the TCI is above 0, that's a bullish signal. That either suggests that the current current uptrend is likely to continue, or that a downtrend is likely to potentially flip soon. And then negative values suggest that if you're in a downtrend, that suggests confidence that the downtrend is going to continue, or if you're in an uptrend, it suggests that that uptrend might be nearing its end. And so this can act as a bit of a leading indicator. So one of the things I mentioned was that really through this period here, we saw how the TCI really acted as a leading indicator, showing that this was really becoming a unsustainable uptrend here. And then in the summer, this was becoming an unsustainable downtrend. So it flipped green well before we actually hit the bottom and flipped up. So really the advantage of this indicator, in my opinion, over some other trend reversal kind of indicators is that this can act as a leading indicator, whereas a lot of those other indicators act as lagging indicators. You know, price action has to come up. So for example, in the summer with those lagging indicators, price action kind of had to come up to meet them for them to flip bullish. TCI flipped bullish before the price even had reversed, which I think is useful. So for this indicator, I don't envision this really being most useful on its own. I think this is more used in confluence with other indicators. So, you know, if you're in a high risk zone and the TCI flips red, that's even something really to be worried about. Or if the risk level is low, like something like our upside downside potential indicator could tell you, then, and the TCI is flipping green at low risk, that might be a bullish signal. But I do think it's important to just validate, you know, overall, does this TCI seem to be capturing what it's supposed to capture? Is kind of following the green likely to lead to enough profit, and then, you know, selling the red? Is doing that over the price history of Bitcoin, would that have been profitable, or would it not have been? Because even though this is supposed to be a leading indicator and not call the exact tops or the exact bottoms, give you an advance warning, it would still be nice if it is overall catching the overall trends, you know, green for uptrends, red for downtrends, so that overall, if you just followed those signals, you'd be making a profit. So that's what I want to talk about today, doing a back test where we're going to use a very simple testing strategy and just see if over the history of Bitcoin, if this would have been profitable above and beyond a buy and hold strategy. So the test strategy I'm going to be testing here is that you're just simply going to buy with all the money that you have when the TCI flips positive, because that's kind of the bullish, right? So, you know, when it flips green, you buy. So the first second it flips green, you buy. Second it flips red, you sell. Second it flips green, you buy. Red, sell. Green, buy, etc. Doing that over the whole history of Bitcoin. And then you sell everything when the TCI flips negative. So buy when it's positive, sell when it's negative. And we're just going to do everything. They're not going to, no hedging, no holding back any money, just all or nothing for each of those signals when they happen. So the comparison strategy then is just going to be a buy and hold strategy. So this person's just going to have just bought at the beginning and just never sell. Just never do anything, just hold through the whole thing. And I personally see buy and hold strategies as being kind of the main comparison of interest in a lot of ways, because it turns out with markets, and especially with crypto markets, it actually turns out to be very difficult to beat a buy and hold strategy, right? It takes kind of a lot to be able to overcome the kind of the power of just this general positive momentum that's really been going into crypto over these last years. So really that's why I see the buy and hold strategy as being kind of that critical comparison. You want any strategy you'd use to beat a buy and hold strategy, because if it doesn't, then what's the point? You know, it's a waste of time to use some more active strategy. You might as well just be holding the asset. You know, why would you mess around with buying and selling if holding is just better? So that's why I see buying and holding as being that critical one. That oftentimes buy and hold strategies do beat more active strategies, and so if you're going to use a more active strategy, you want it to be better than this alternative. So the setup that I'm going to be using for this this test is that both kind of players, so both the person using the TCI based strategy and the person using this buy and hold strategy, are both going to start with $100 worth of Bitcoin, and then this person's going to be buying and selling based on TCI level. This person's going to be holding, doing nothing. So there are a couple assumptions in this that I do just want to make note of that I think are important to highlight here. So the first assumption I'm making is that this TCI person is going to be hitting this cutoff price exactly. So with the trend confidence indicator, you can calculate that exact level at which it will flip from essentially red to green. It'll flip from positive to negative. So, that 0 level of the TCI, you can actually get the TCI algorithm to tell you what price level it's looking at as being that kind of critical value above which it's going to be kind of bullish and increasingly bullish as things get higher, below which it'll be bearish and increasingly bearish the lower it gets. So you can calculate that 0 point from the TCI. So that's one assumption I'm making, is that this person is going to be exactly hitting that cutoff price. So if it flips positive, that they're going to be catching that immediately. When it flips negative, they're going to be catching that immediately. But then the other assumption I'm going to make is that this is probably not going to be totally possible. That if you're actually going to be doing this, there'll probably be some messiness that goes in with getting in and getting out. Like if the price is just kind of getting closer, flipping up above and below a couple times, whatever the case may be, it's probably the case that you're not going to be perfectly getting in and out of that exact level. So what I did to kind of account for that kind of imperfection that would likely be the case is I've just given a transaction fee penalty. So instead of just using a typical transaction fee, I've just amped it up to be higher. So obviously with this, I didn't go back to look and see what historical transaction fees would have been at the early days of Bitcoin on exchanges. What I did is I just used current exchange transaction fees. So for example, Coinbase Pro has a transaction fee of 0.5%. Binance US is 0.1% transaction fee. So I used a 1% transaction fee. Just to be really kind of more conservative for this backtest, right? So kind of assuming that you're paying a pretty hefty transaction fee relative to what the actual alternatives are in exchanges nowadays. But I'm just doing that to just kind of assume that there's some messiness in hitting this cutoff price. So the results here should be more conservative than if we assume a perfect execution of this. And it is possible that you could perfectly execute this, right? If you're using kind of more algorithmic-based trading, if you're using a bot, for example, that might be able to perfectly hit this, or you have some way of kind of hitting it more precisely. But I'm just kind of assuming there's some messiness, so that's an assumption built in. So I just wanted to be transparent that those are going into this simulation. Okay, so yeah, so that's what's happening. So let's look at the results here. So this is just showing the TCA person. This is just in a linear scale here. So this is the total value that they have throughout this time. And remember, they started with $100 worth of Bitcoin at the beginning. So you'll note that these are in increments of, let's see, 1, 2, 3. Yeah, these are increments of $5 million on the y-axis. So every line here is $5 million. So you can see that this person would have turned $100 into around $70 million. I think it's just over $70 million here. So $100 to $70 million over the history of Bitcoin. Not bad, right? Throwing $100 of Bitcoin in back in 2010. That's when my data for Bitcoin starts back here. Back in 2010, and then following the strategy, you'd have $70 million, over $70 million. I think most people would be very happy about that. I think it would be hard to believe that someone would be upset about that. And importantly, if we compare this to the buy and hold strategy, it destroys it, right? Look, it crushes it. It's over 2x higher, actually, when you look at the actual numbers. So that's what I'm showing here. So there's two things that I've added to the graph here. So this yellow line is the total value for that buy and hold person. They would have ended with 32 million. Not bad, of course, but less than half of what you would have gotten with this TCI-based strategy here. And what I've added with this green line here is this is just to show the cash position of the TCI person. So essentially when the green line shoots up, that means they sold, and then when it goes down, that means they bought. So, when they go up here, that means they sold, they held, and then they bought back in. Sell here at the peak here in 2019, hold for a while, buy back in at a lower level. Sell right before the COVID crash, buy back in, ride that up. Sell before the summer, buy back in, et cetera, et cetera. So that's what this is just showing under the hood what's going on, where the TCI strategy is making those buys and those sells. And we can actually see this a little bit more clearly if I just flip to a logarithmic scale. So obviously this doesn't look as impressive in some ways as a linear scale, because again, with a log scale, every line here is a 10x going up. So this difference here, though, is still very significant, right? You know, that's this difference just in logarithmic form. But what's nice about doing this in the logarithmic scales, we can actually see over time what exactly is happening with the TCI, what exact decisions it's making of when to buy and to sell. And what you can see is that, generally speaking, it will sell before it gets to the actual bottom of whatever the localized bear market is, or like here, it's just kind of riding some of those smaller kind of uptrends throughout. So it's kind of keeping its pace. Now, the one thing that's interesting is that it actually does about equalize by the time we get to the top of 2017. But then, you know, it catches up. It holds its own. It does way better than the bear market than the buy and hold person, and that it holds that advantage throughout. And so really with this kind of a thing, as I mentioned before, you know, I don't even see this as being the way of using the TCI, right? I don't see the TCI being a standalone trend indicator that you would just use on its own, you know, buying above zero, selling below zero. I actually think it's a lot more useful when you look at it as to have its leading indicator properties, right? Because for example, in the summer right here, you know, it flipped green before we got to the actual bottom. So you might not necessarily want to actually be buying the second that the TCI hits green, but instead what this would suggest to you is that, hey, start paying attention, right? Start paying attention right here, because bullishness seems to be re-entering the market, even though the price actually hasn't realized it yet to some degree. Even though we're still moving down, pay attention, because an upward move seems very plausible, and that's exactly what ended up happening. Or like in the spring here, back in 21, that, hey, be careful, this uptrend is not very convincing anymore, and then indeed, and it crashed and went all the way down. So really with the TCI, you know, I see it more as being a way of kind of gauging where we are in a given trend, and not to say that when it flips green or flips red, that's necessarily the top or the bottom. That's not really the point of this indicator. It's supposed to be a leading indicator in a lot of instances to give you a warning of when a given trend might be gaining steam or losing steam, for example. But I think it's quite impressive in some ways that even given those properties, even though it's not even designed to be used in the way that I'm using it here, you still would be outperforming the market by over 2 times over Bitcoin's life. And so, you know, 70 million versus 32 million, pretty darn good in my opinion. So really with the TCI in the future, what I want to do is think about some strategies that might make more sense for it, given the way it's actually designed to be, right? I think one strategy could be something like combining it with the UDPI, where maybe you take those trend indicators being more seriously when you're in higher risk levels, right? So if the TCI flips bearish, maybe you start DCAing more heavily out of the market, for example. Or when it flips bullish down in a low risk zone, maybe you start DCAing more heavily into the market at that point, because there's some indication that upward price action might be following. So kind of using the TCI to guide a dynamic DCA strategy or a weighted DCA strategy into the market could be really interesting. It's something I'm going to look at in the future. But I just wanted to share this as a validation of the TCI, right? That if you had been trading on it in this very kind of just bare bones kind of brute force trading strategy like this, you still would have caught a lot of up and saved yourself from enough down that you'd be up over 2x over the history of Bitcoin. And of course, depending on exactly where you look, you'd be up even more during some of these stages than where you are right now. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the UDPI and the TCI, we're all going to make it.